Good morning. Thank you for joining us today for the webinar, The Secure Act, What You Need to Know and Why, with Brian Eisenmenger. Brian is a certified public accountant and a partner at Matheson, Moisky, Austin & Company in Wheaton. His work concentrates on serving corporate executives and successful small business owners with their tax planning needs. Brian earned his undergraduate degree in accounting from Eastern Illinois University and his Master of Science in Taxation from Northern Illinois University. Now teaches in the Graduate Master of Science in Taxation program as an adjunct faculty for Northern Illinois. He is a frequently requested speaker for Thomson Reuters, a top company that provides training, software, and continuing education to accounting firms. In fact, he's already spoken to 3,000 people on the topic of the Secure Act this year. Just this week, Brian received his certification in valuation services, adding another set of initials to his name. Former board member and treasurer of the Wheaton Chamber of Commerce, Brian's here today to tell us about the Secure Act. Please help me welcome Brian Eisenmenger.
All right, thank you, Carrie. Let me go ahead and get the camera on. And so, let's see, how do I put this camera on?
You're on.
There we go, that's it. Thank you, everyone. Well, welcome. We are so excited to have you here today as part of our first webinar for the Wheaton Chamber of Commerce. And also, it's the first webinar that Matheson, Moisky, Austin & Company has put on. And this is a day of firsts for us all. What we are going to be talking about is the Secure Act, if you didn't know why you were here, and what you need to know about it and why. So the first thing, the goals of this webinar is that you will be able to understand the major provisions of the Secure Act. There's a lot of provisions to the Secure Act. I believe there's over 27, if memory serves me correctly. We're not going to go through all of them, but we are going to go through the major ones that affect small business owners and also individuals. We're going to talk about tax savings opportunities that are available in the Secure Act, show you expanded retirement savings opportunities, and then the last thing we're going to do is help you understand the new rules for beneficiaries of inherited individual retirement accounts. Now, the first question you might have, as I can move this forward, is what is the Secure Act? Well, what it is, it's the Setting Up Every Community for Retirement Enhancement Act of 2019. It was passed by the U.S. House of Representatives on May 23rd of 2019, and then it sat. It sat in the U.S. Senate until mid-December, and there were some senators who didn't like some of the provisions from the act, and it was interesting to look at the bill that the Senate had and the bill that the House had, because they were so similar, and you, as just an impartial observant, you looked at it and said, why can't these two sides get together? Well, they finally did get together on December 19th, and they signed it into law, and then, or they passed it, and then President Trump signed it on December 20th as part of the Further Consolidated Appropriations Act. Now, you might ask yourself, why now? Why did they do the Secure Act now? Well, one of the reasons, and probably the major reason, is that every statistic that you look at on retirement savings has that Americans have not saved enough for retirement. It's a big concern. Now, there's a lot of statistics out there, and I'm always leery of statistics because I'll point out where I think some of the statistics are wrong here, because as anything else in life, you can do anything with statistics. But most of the retirement planning statistics are pretty dire. Now, one of the first statistics that we have here is that over 55% of adults participate, only 55% of adults participate in a workplace retirement plan, whether that's a defined benefit plan, like a pension plan, or a defined contribution plan, like a 401k plan. that means about half of the workforce doesn't have a retirement plan in which to participate in. The second one, and this next statistic is, I think, a little fuzzy, because it says here the median 401k balance for people age 65 and over is $58,000. And I have to wonder about that, because I know a lot of our clients, what they do is when they leave a company is they move their 401k balance to an IRA. So I don't know how that plays into the statistics on that, but it's a pretty dire statistic. The next one, as well as 20% of Americans have no retirement savings, and 10% have less than $5,000 in retirement savings. So there's a lot of people who have not saved as they should for retirement. Also, people are working and living longer, and they're also working longer than they ever have before. More than 20% of Americans age 65 and older are either looking for work or are working as of February 2019, and that is double what it was in 1985. The average life expectancy, I believe, if I'm not mistaken, is now 78.6 years. It used to be, back when Social Security first started, is a person would work up until age 65, they would retire, and they would no longer be with us a year after retirement. Well, that is not the case anymore. People are living longer and working much later into life, and so that's what's going on in why they passed this. They're concerned about concerned people have not saved enough, and then they're living longer, and so they're afraid that people are going to run out of money. So what happens is the Secure Act, when they passed it, they broke it down into 3 buckets. And the first bucket that they broke it down into was to increase the availability of workplace retirement savings plans. And what they did by this, and we'll talk about this, is that, for example, they're allowing part-time workers to participate in retirement plans. They're also doing some things to allow, and we'll get into the details on this in a little bit, but they are allowing people to, or allowing companies to set up retirement plans later than what they were in the past. And they've updated the rules to increase the longevity of individuals' funds, and we'll talk about that. And then there were some other miscellaneous tax rules that were part of the act, and we will touch on one of those later on in our webinar. So the first thing that what we're going to do is, when we talk about this, we're going to start out by talking about those parts of the act that affect employers, and they primarily affect small employers, which makes sense because small employers are the ones who either don't have 401k plans or the participation in them is smaller, whereas large employers already have a retirement plan that they've set up. But the first thing that they've done with the Secure Act is that they've increased the credit for plan startup costs. What this means is that, and what it was before the act, is that there was a $500 credit available to a small business that set up a retirement plan. And what they've done with the Secure Act, and what that was, is, let me explain what that credit was for a moment. That credit was was to help pay for the cost of the plan. Basically, you'd have, when you set up a retirement plan like a 401k plan, you have setup costs. And so what the government said is, because you have these setup costs, we will give you a $500 credit, $500 back on your taxes for setting up the 401k plan. Well, what they've done with the Secure Act is they have increased this from $500 it's to the greater of $500 or the lesser of $250 per employee or $5,000. So what does that mean? Well, that means that the minimum amount of the credit is going to be $500. That's the minimum. But if you have, let's say you are a small business with 10 employees, so that you've got, and it's got to be 10 non-highly compensated employees. Non-highly compensation is a term of art in the 401k plan world. So think of it as a non-business owner. So you've got a business owner and 10 employees who are considered non-highly compensated. You get a $250 credit per person. So in that case, it's $2,500. It's the lesser of $2,500 or $5,000. So hopefully I didn't confuse you on that, because I sometimes speak in circles and I apologize for that. But what that means is that a small business owner with 10 employees can get a $2,500 credit to help pay for the costs of setting up a 401k plan. So again, what this is going to do is that it's going to increase the startup costs so that, or excuse me, not increase the startup costs, but it increased the credit so that more small businesses will be able to afford setting up the retirement plan. Now, the next question I have is, well, what's considered a small business? Well, the IRS considers a small business to be one with less than 100 employees who receive at least $5,000 in annual compensation. So again, that's who this is geared towards. And again, for a larger business, they probably already have a 401k plan set up. So this is geared towards getting small businesses into the game, offering a retirement plan for their employees. Because again, as you saw in the statistics that we had earlier, about half the workforce does not have access to a retirement plan. So this credit is available again for qualified pension plans, profit sharing plans, stock bonus plans, qualified annuity plans, simple pension plans, which I find interesting because simple pension plans don't have a lot of startup costs typically associated with them. And then simple retirement plans like simple IRAs and simple 401k plans. And this provision, as most of the provisions that we're going to be talking about, is not in effect for 2019, but it's going to be in effect for plan years beginning after 2019, so 2020 and beyond. There are some aspects of the Secure Act that were retroactive, but most of the part of the Secure Act was for 2020 going on, and this is one of those provisions. Now, the next one is that the Secure Act, what Congress gave us, is a small employer automatic enrollment credit. So let's talk about what automatic enrollment is. Well, what automatic enrollment is it's where now when someone joins a company, you can have it set up that they are automatically enrolled in the 401k plan, into the retirement plan. And so they are automatically enrolled. And the idea behind this is that perhaps if an employee is automatically enrolled, then they will participate, and it will increase participation into the savings program. Well, what the Secure Act does, and again, an employee can opt out of the automatic enrollment, but the idea is that to have an employee come in and they automatically are involved in the 401k plan. What the Secure Act does is it actually creates a new credit of an additional $500 per year for employers who have this automatic enrollment, or not who have it, but who start automatic enrollment. So if it's a new plan, this is in addition to the credit that we previously talked about. If it's a plan that has been in existence but does not have automatic enrollment, then that employer can get this credit as well. So again, this is to help defray the costs that are associated with setting up a retirement plan, and the cost to maybe have a financial advisor come out and have those and have the plan talked about and whatnot. So again, this is again available to small employers, those with 100 employees that receive greater than $5,000 of annual compensation. It's also in addition to the plan startup credit that was allowed, that we talked about previously. And again, it's available to employers who convert an existing plan to an automatic enrollment plan. And this is for tax years after December 31st, 2019. So again, 2020 going forward, this is something that a small employer can implement for 2020. Now, the next part of this is that automatic enrollment credit, excuse me, the automatic enrollment cap is right now, or I guess up in through 2019, the automatic amount that could come out of a person's paycheck was up to 10%. Now, under the Secure Act, they can automatically go to 15% that's taken out of a person's paycheck. Now, it's not that dire for employees, because you might say, well, what about the employee who does not want to participate in the 401k plan? It's not a big deal. The employee can opt out. But again, the idea is to get employees into the plan right away and get them involved so that they have retirement savings when they go to retire. And again, this part of the Secure Act is for 2020 going forward. The next one that we have is a little wonky, so stay with me on this as best you can, but it's important for small business owners to be able to understand this. And that is that under the Secure Act, non-elective 401k safe harbor plan notice requirement is eliminated. So what does that mean? Well, what happens is when someone has a 401k plan, they have to notify the employees of how much they are going to match or how much they're going to put into the 401k plan. Most companies, or I should say many companies, choose to do a dollar for dollar match for up to maybe 3% of the amount that the employee puts in. However, some companies say, we're not going to do dollar for dollar match. We are just going to put in X amount of dollars, X percentage of each employee's salaries to the 401k plan, whether they contribute or not. That's considered non-elective. So I have a company and I have, let's say, 50 employees, and I say at the beginning of the year, I'm going to put 3% of everybody's wages in, not out of their wages, but as the employer contribution, 3% of people's wages into the 401k plan on their behalf. That would be non-elective. The employee gets that whether or not they participate or not. So what happens with this, it's very difficult, as you can imagine, for employers to predict, and especially small employers, to predict what's cash flow going to be like, how's business going to be for the year at the beginning of the year. I mean, you hope it's going to be a good year, but you don't know that. And so what this is allowing is that this notice requirement can now be done at any time before either the 30th day before the close of the plan year or the last day for distributing excess contributions from the plan. So that's what this is for. And it's the idea is that this will allow employers who might have said, we're not going to contribute anything, to now say, yes, we are going to contribute. Now, you might say, what is safe harbor and what does that have to do with? Well, safe harbors, 401k plans in particular, have to be careful that they do not just benefit the higher ups of the company. And so in order to do that, the IRS has put in, and the Department of Labor for that matter, have put in safe harbor provisions so that if the employer meets these requirements, then the plan is considered safe harbor, and the higher ups don't have to give back part of what they've put into the plan. Now, there is a payoff or a price to pay that the IRS has if you become non-elective and you choose to do it, that late in the year. And what that is rather than having to put in 3% of an employee's salary, now you've got to put in 4%. That's the way that's the penalty, I guess you'd say. It's not a penalty, but it's the way that Congress disincentivizes you to wait until the last minute. Now, then the next thing that the Secure Act does, and we will be getting into the individual portions, but I did want to go through the employer portions first. But the next thing that the Secure Act does is, now it used to be under the Secure Act, or before the Secure Act, excuse me, it used to be that you had to adopt the plan so many months before year end, depending on the type of plan. Well, now what's happening is that you can adopt a 401k plan as of the last day of the taxable year. And what this does, this again provides flexibility for employers. Now, employers already have had something like this with SEP contributions. The idea with SEP contributions is you can contribute to a SEP plan all the way up to the day that you file your tax return, including extensions. So you'd be able to contribute to the SEP plan in 2020, in perhaps September of 2020 or even October, and you would be able to have that considered as your 2019 contribution. Well, what the Secure Act does is it's expanded this beyond SEP plans, but also allows this for 401k plans. So employees can receive contributions for that earlier year, accumulate additional savings, and accumulate additional retirement savings. The next one is portability of lifetime income options. This is something that affects participants in 401k plans. What happens is that many 401k plans have annuities that they are allowed to invest in their 401k plan. And the idea behind the annuity is that it would provide a rate of return, but the problem with their annuities and a problem with this is that they have surrender charges and fees if someone gets out of the plan and leaves the plan. So what the Secure Act does is it allows for a direct trustee-to-trustee transfer to another employer-sponsored retirement plan of that annuity. So you can move, if you're at company X and you have an annuity there and you leave that company and move to company Y, you can take that annuity with you and put it in company Y's 401k plan, or for that matter, into your IRA. And the idea behind that is that way, as an employee, you would not be subject to any surrender charges or fees. And again, this is effective for plan years after December 31st, 2019. The next one, and this is something that's going to be coming up for employers in the future, and that is right now, when you get a statement from your retirement plan, what you get are is the statement that shows what fund you're invested in, where you're invested, and how much it's worth as of, for example, December 31st. Many people just got their statements probably not too long ago. Well, what is going to happen going forward, and this hasn't been implemented yet, but retirement plans are going to have to start, when I say retirement plans, 401k plans are going to have to begin 401k plans. I'm sorry, excuse me, I just got distracted for a moment. What happens with with these statements is right now you just get a statement and the balance. What they're going to do is they're going to start providing on the statement, this is how much money your 401k plan would be worth in terms of a monthly payment to you if you were to annuitize the 401k plan. And so annuitize means turn it into monthly payments. So what that's going to do is, and it has a lot of employers a little concerned because they're saying, what kind of responsibility do we have on this? We don't have that. Well, the Congress has put in this that it would not increase the burden to employers, that they have no responsibility as to whether those results are actually achieved, but the employee is going to at least be notified that, hey, this is the amount of that your per month that your 401k would provide. The idea, again, and Congress did this back a few years ago, many years ago, with regards to Social Security. The idea is for an individual to look at that and to say, oh my goodness, I have not saved enough for retirement. I need to put more away. And so that's what's behind this. A couple questions have come in. One came in about, what about transfer fees if you are still with the same employer, but the employer changes plans? I believe, if I'm not mistaken, that you're going to be okay in that situation as well. In terms of not having the fees and surrender fees associated with it. And then someone also asked a question if they could get a PDF of the presentation. I bet we'll be able to get that to you, no problem whatsoever. So with that, let's see. So that's, again, what we talked about with regards to the 401k plan and the lifetime annuity. And I cannot get this. I'm glad you walked in because I suddenly cannot get this to move along. I'm sorry to do that to you. It froze up on me. Let's see. There we go. Got it. Sorry about that, folks. The next one, this one is huge in my mind. This is one of the biggest and coolest parts of the Secure Act, in that now part-time workers are going to be allowed to participate in the 401k plan. So previously, employers could exclude part-time employees. And, this really was unfair to many women, because women are more likely than men to work part-time. And so that would impact their ability to save for retirement. And again, most people are also working part-time after they've achieved age 65, or they've chosen to maybe retire full-time, retire from full-time employment. Because most people, what you're seeing now is a trend of, it used to be people would work until retirement age, and then they would completely retire. Well, what we're finding now is that most people, or I don't say most people, but many people are easing themselves into retirement. So as they're easing themselves into retirement, what's happening is that they're going from working full-time, going 55 miles per hour, to working part-time. and easing themselves into retirement. So this is something that now those part-time workers are going to be allowed to participate in the 401k plan. And what this does, there's two requirements on this. In that, one, employers have to have dual eligibility. They have to have 1 year of service or 3 consecutive years of service. I'm sorry, 1 year of service with 1,000 hours, or 3 consecutive years of service with 500 hours. So that's what the rule is. Now, you might ask yourself, if you're a small employer, that, and you might say to yourself, that's great, but do I have to match that part-time employee? Is that part-time employee going to have a negative effect on the testing of my 401k plan? And it's not. So so that's how that works. The next one we want to go through, and I'm going to fly through this a little bit, is that, and I was actually talking to Carrie on this morning, in that unrelated employers now can reunite for and maintain a 401k plan. And now they've been able to do this for some time, but there was what was called the bad apple rule. And that was, if one company was out of compliance in the 401k plan, the whole plan was out of compliance. So what's happened is that the Congress and the IRS are providing relief from this rule and allowing employers to pool together and have a 401k plan. And the idea behind this is that would lower the administrative costs and provide relief from violations that maybe jeopardize the tax-favored status of the plan. Now we're going to get into some of the items for individuals. And the first one is that the maximum age for contributing to a traditional IRA is now increased from age 70 and a half to now there's no age limitation. So what it's been before is that if you worked and you were 75 years old, that was great, but you couldn't contribute to your IRA. What this is saying, what this has changed, is they've taken away that 70 and a half age. And now if you're a part-time worker who's 75 years old, you can, if you desire, can contribute to a traditional IRA, you can contribute to a Roth IRA, you can contribute. Now, this is effective for tax years beginning after December 31st, 2019. So you can't do it for 2019, but you will be able to do it for 2020. So these are a pretty good way to supplement retirement savings for someone who's over age 70 and a half. The next one, and this has a lot of people excited about it, is that now the age for minimum distributions is increased. So what it was before the pre-Secure Act is you were required to take minimum distributions from your retirement plan at by April 1st of the year following age 70 and a half. You had to start taking money out. Well, what the Secure Act has done is they've changed that. They changed the Internal Revenue Code, crossed out age 70 and a half, and pushed it to age 72. And what this does is it gives employees gives a participant with an IRA or 401k, gives them an additional 18 months. It says 19 on your screen, but it should be 18. What's a month between friends? But it should be 18 additional months to take advantage of tax-deferred growth before making required withdrawals. So now, rather than it being age 70 and a half, it's now age 72. The next part of the Secure Act affects young parents, really, because what happens with the Secure Act is now new parents can withdraw funds from their IRA, from their 401k plan for qualified birth and adoption expenses. So what it allows is $5,000 per parent. Now, you got to be careful with this and a couple of things. You can withdraw funds from your IRA or 401k plan without penalty. So that's the idea, because if you withdraw funds early from your 401k or IRA, you're hit with a 10% penalty. That's what this takes away. You still have to pay income taxes on the withdrawal, but you're not subject to the 10% penalty. Now, the maximum distribution is $5,000 per parent. Now, what that means is that if I have an IRA and my wife has an IRA, we can each take $5,000 out of our IRA. However, if my wife has an IRA and I do not have an IRA, then only she can take out $5,000. We cannot take $10,000 out of her IRA. It's just $5,000 per person not per IRA, but per person if they have a retirement account. The next one is that allows for tax-free distributions from 529 plans to pay for principal or interest on education loans of designated beneficiaries or siblings. Before the Secure Act, you could only use education loans for 529 plans to pay for education expenses. What the Secure Act does is allows for the 529 plan to be used for education loans up to $10,000. Now, the other thing you can do is you can pay for your for a sibling's education loan. Excuse me, I might have said $5,000. It's $10,000, up to $10,000 out of it. So what this means is this: I have a 529 plan for my oldest daughter. She gets out of college and she has student loans. I can take $10,000 out of the 529 plan and use it to pay down the student loans. I can also use it, I have a younger daughter, to pay $10,000 out of that to pay for my younger daughter's student loans. And I can do that without changing the beneficiary. So that's what's helpful with this. Now, you've got to be careful, because you might say, well, I've got multiple 529 plans. What I'll do is I'll take $10,000 out of this 529 plan and pay down a student loan for my oldest daughter, and then I've got another 529 plan for my oldest daughter, and I'll pay $10,000 out of that. And no, that's not the way it works. It's up to $10,000 total per beneficiary. And so that's but previous to this, you could not use 529 plans to pay for student loans. The next one on this is that, and this is, we don't have a slide on this, but I think it's very important. Before 529 plans were allowed to be used only for college. And now what's happened is the 529 plan can be used for trade schools. So if you have someone who goes to a trade school, and trade schools can be expensive, you can use a 529 plan to pay for trade school. And that is actually effective for tax year 2019. So pretty cool provision with that. Now, the most controversial part of the Secure Act is the new rules for inherited accounts. Heirs can no longer withdraw funds throughout their lifetime. What that means is, previous to the Secure Act, you could do what was called a stretch IRA on an inherited IRA. So you have a parent, let's say, parent passes away, leaves you their IRA. you could, if you so desired, you could withdraw that IRA over your lifetime based on your life expectancy, and you could stretch out the IRA over over so many over your life expectancy. Well, in order to pay for this, what Congress has done is they've said no more stretch IRAs. Now, if a person dies after 2019, they have to draw down the IRA balance within 10 years. So they have to draw it out within 10 years. Now, they don't have to do it equally over 10 years. They can wait until the end of, till year 10 and withdraw it all out, but no more stretching it out over your lifetime. Now, if you've inherited an IRA and you had someone who passed away in 2019, you can still stretch those IRAs. You are, for lack of the pun, lack of a better word, you are grandfathered into this, into this rule. So for existing IRAs, you can still stretch, or existing inherited IRAs, you can continue to stretch. But for someone who dies in 2020 and beyond, now they have to be withdrawn in 10 years. That has a lot of people upset because obviously they enjoyed it. There was a way that they could control their taxes by doing that. So there are some exceptions to that, and one is if you are the surviving spouse of the IRA owner or the employee, you are exempt from that. Also, if you are a minor child of the employee or IRA owner, what can happen is you can take out, that minor child can take out the IRA over their life expectancy, but once they meet the age of majority, then it has to be taken out over 10 years. The last one is that a chronically ill individual, someone's chronically ill, then they can take it out over their life expectancy. But after they pass away, it has to be withdrawn in 10 years. And then the last one is that the individual is not, the person who inherits is not more than 10 years younger. So let's say you have someone pass away and they leave it to their brother or they leave it to their sister. Then in that case, if that individual is not 10 years younger, then what can happen is they can stretch that out over their life expectancy in that situation. So other tax changes that come into play is the kiddie tax rule. And what they did is there's no kiddie tax. Well, I don't say there's no kiddie tax, there's still a kiddie tax, but what they did under the Tax Cuts and Jobs Act that was passed is that they made the kiddie tax just like estates and trusts in terms of their income tax. And income taxes of estates and trusts go up really high, really fast, and they get taxed at the highest tax bracket at $12,750. And so what they said is that, and that was implemented on children. And so what would happen, well, not what would happen, is that people were paying taxes on this, and they felt that this was unfair to survivors of military personnel, first responders, emergency medical workers, etc. And so what they did is they repealed this. And we've gone back to the old rules on the kiddie tax that now a child is subject to their parents' tax rate. And now the neat thing about this part of the rule is that this is going to lower taxes for children, is that if you have a child who was subject to this kiddie tax in 2018, you can go back and amend their tax return and treat it like it was the old, or under the new rule of having it taxed at the parents' rate. So where does this bill fall short? Well, it falls short on a few accounts, and that is a lot of people still don't know how much they're going to need for retirement, and all the although the bill makes some strides towards this, it's still it doesn't really address it as well as some people would like. The next part is that many retirees and non-retirees, for that matter, aren't comfortable managing their investments. And most 401ks and IRAs are self-directed. So if 60% aren't comfortable with managing their investments, then it doesn't address that, and it doesn't help that situation. The next part is that the solvency of Social Security is still being ignored. So they're kicking the can down the road on that, and it's still a problem. So what do you need to do? I'm going to take about what you need to do, and then we'll open it up to some questions. And the first thing that we want to do is you want to review your beneficiary forms. You want to make sure with your IRAs and 401k plans that you have who you want. This is always a good practice to have, to review them on an annual basis to make sure that your money is going to go to who you want it to go to. The next one is if you have an estate plan in which you have a trust that holds an IRA, and the idea behind that was to preserve the stretch benefits, then you're going to want to review that trust document. And I'm not an attorney. There's plenty of attorneys in the chamber who can help you with this, but you'll want to look at the idea that you can't stretch this anymore, and so you'll want to maybe have your estate planning documents looked at if you have a trust that's the beneficiary of your IRA. What you might want to consider doing is actually having the IRA balance paid to a charitable remainder trust. And the way a charitable remainder trust works is that the IRA goes to the charitable this charitable remainder trust. Then the income from the trust is paid out to the beneficiary, maybe over their lifetime, but at the end of the trust, the amount goes to a charity. That's why it's called a charitable remainder trust. That would be a way to stretch the IRA for your beneficiaries, but you've got to be careful with that because, well, you've got to be charitably inclined with that because the charity is going to get some of the is going to get part of your IRA. Also, you might want, if you can, look at the idea of delaying distributions from your IRA until age 72. You'll want to continue to save and contribute to an IRA, Roth, IRA, solo 401k, or 401k if you're still working. And then the other thing that you might consider doing if you are in retirement age, and this is a conversation I'm having with many of my clients right now, and that is the idea of converting your IRA to a Roth IRA. Now, let's see, why would I want to do that? And I'm not talking about converting all of your IRA, but I'm saying maybe you are in a tax bracket. If you are in retirement, most retirees are in a lower tax bracket than when they are working. And they might be in a lower tax bracket than what their children are in because their children are working. And so what they could do is if they convert part of their IRA, not all of it, but maybe one that maxes out their tax bracket, like if they're in the 12% tax bracket, they would pay the tax, convert it to a Roth IRA, they would pay the tax on it at 12%. That might be better than having a child inherit it who's paying taxes at 22%. Or higher, 24% or whatever, or maybe 37%. So those are things that you might want to consider. So at this point, what we can do is we will be happy to take your questions at this time. So feel free to ask your questions, and we will be happy to take them. So let's see. Haven't seen any questions come in. I'm sure we've got a few questions out there. How are we doing on time, Carrie?
10 minutes.
We've got 10 minutes to go, so please feel free if you've got any questions. Well, while we're waiting for those questions, what I'll say, Vicki Austin raised her hand. Okay, Vicki, go ahead. What's your question, Vicki? How do we have you, how do I see this? I can see where someone asks a question, but I don't see what we can do when someone raises their hand. What do we do with that? And Carrie's going to come around and help me.
That's for when maybe they're on audio. If perhaps the person who raised their hand could type in their question instead.
Oh, okay. Can I talk about the sibling contribution? I'm not sure if you mean the sibling 529 plan or the sibling inheriting a an IRA or 401k plan. So I'm going to talk about the 529 plan. So what can happen with the 529 plan is, as I said before, you can have a 529 plan used to pay $10,000 of student loan payments. What you'd have to do is, if you wanted to pay for a sibling's, like another child's student loans, then what you would have to do is you'd have to change beneficiaries in order to do that. What the Secure Act is doing is they're taking that step away from having to change beneficiaries. And so what you can do is you can pay for, as I said, $10,000 on the oldest person's 529 or oldest child's student loans, and then you can also pay for the for the youngest child's student loans out of that 529 plan. Same 529 plan without changing beneficiaries. So a total of $10,000 per person, up to $10,000 per person. So that's what you can do. All right. Any other questions coming up? Well, we really appreciate it. Obviously, if you have questions on any of the Secure Act and you're unsure of what you need to do, I would just encourage you. I'd be happy to have you take your phone call or have you come in for a sit down, and be happy to do that. We're just very excited about the planning opportunities that are put in here, and we want to make sure that you understand them. So, and we want to thank the Chamber today for the opportunity to be part of your first webinar, and it's also our first webinar at MMA, and we're excited that you would have us be part of this. And we're so excited too that you took time out of your day to be with us on this. I know we're all very busy, and we thank you for taking the time, and we hope you got much out of it. So with that, Carrie, are you ready to wrap things up, Carrie?
We are.
All right, Carrie.
Can you just mention really quickly the best way to contact you?
Oh, sure. The best way to contact me is probably via phone. Our phone number is 630-653-1616. That's 630-653-1616. Or you can contact me via email, but it's not fair because my email address might be the longest one in the world. It's Eisenmenger at MMAadvisors.com. I would just call the phone number, 630-653-1616. So with that, Carrie, I'm going to turn it over to you and let you wrap it up.
Thank you so much, Brian. As the Chamber is super excited to have the opportunity to have people right here in our community who care about your business and what happens to you and your future, advise us on the new ways we can make the best of our business and our money. We will be sending out the presentation in PDF form to you shortly, and please get back to the Chamber if you have other ideas for webinars or other education things that would be helpful to you. As Brian mentioned, we have plenty of attorneys and other business professionals in the community who have your best interests at heart. Chamber signing off from our first webinar. Thanks, Brian.
Thanks,
Thanks
Carrie.
everyone for joining us today. Bye-bye. Sure did.